Hey guys, as promised, I was going to walk through every single in-class exercise that we worked on in class. We didn't get through a whole bunch of them, but that's okay. I wanted to go through, and we're going to do 1 through 8. Don't worry about 9. The reason why is because 9 is redundant, and if you want to do it on your own, great. For practice, you don't have to do that. I'll still do the video for number 9 just to give you another opportunity to see what we're doing and how to do it. So what I have on the screen here is problem number 1, right? Consider the simplified financial statements for the WIMS Corporation. And they tell us that the company has predicted a sales increase of 16%. Fantastic. They also tell us that, oh, by the way, in addition to this 16% increase in sales, every other item on our balance sheet is also going to increase by 16%. Fantastic. So first I'm going to do the income statement. Always want to do the income statement first. Okay. Why? Well, because remember in accounting, way back when you had it, net income feeds into our equity, specifically retained earnings, right? Excuse me, because if you remember in class, we said that, okay, we have equity, but equity is made up of a bunch of different pieces here, right? We have our additional paid-in capital. We have our common stock. We have our treasury stock that's under there. And we also have retained earnings. So all those things make up equity, okay? Net income impacts equity, yes, but specifically, it impacts retained earnings, okay? So first thing I'm going to do is my income statement. Basically, I'm going to take my revenues and make sure it increases by 16%. Take my costs, make sure they increase by 16%. Notice I have my 1.16 right here in cell reference A7. I'm just going to use that so I can use Excel, and I don't have to worry about really punching any values in per se. So our new revenue with the 16% increase is $38,512. We're going to do the same thing for costs. $25,440 were the original costs. Well, those have to go up by 16% as well. If sales are going up, costs have to go up with it. Okay? So then we get the new net income, and I'm just going to subtract here. I'm going to take my revenues minus my costs, and I end up with $9,002. That is my new net income. Okay? So now what I'm going to do is I'm going to go ahead and I'm going to create my balance sheet. So my assets also increase by 16%. And so does my debt. And so does my equity. Okay, so I just went through real quick and said, you know what, I'm going to make sure that I increase everything by 16%. Did that, okay? Now what I want to do is I want to add up all my assets, or total up my assets, and I want to total up my debt and equity. Okay, so I look pretty good here. Assets equal liabilities plus owner's equity. Balance sheet balances look sexy, right? Now, there's something that we need to recognize here that's very important, okay? Let's look at our change in equity. Okay, change in equity. Our equity was $15,500. Okay, we're okay with that. Our new equity is $17,980. Now let's take the difference between these two. $2,480. We have a problem. Okay, and you might be saying, well, why do we have a problem? Because our balance sheet balances were good. Correct. But we're missing some information here that we can go ahead and kind of plug in, right? We know that net income is going to increase our equity. Okay, we know that. So our projected equity should be my beginning equity, right? 15,500 plus my net income of 902. So equity should be 25,000 or 24,502. It's not. It's 17,980, right? So what happened? What happened between the net income flowing to the equity? Well, we must have paid dividends. So we need to figure out how much we paid in dividends, okay? So to do that, we take our net income, which we know is $9,002. We then take the change in equity. Change in equity, okay? Which we just calculated. It's 2480, okay? So the difference between these two is our 6522, okay? That basically what we're saying is our change in equity, how much our equity should have went up, it should have been 24,502. It's actually 17,980, okay? So we have a problem, right? All that net income did not flow into equity. Where did it go? Well, we paid a dividend. So this is our dividend. That's why our equity is 17,980. Another way to look at this, let me give you another explanation, and I'm just going to assume that it's a little tricky for you. So our equity was 15,500, okay? Net income was $9,000 or $9,002, okay? That means the equity that we should have is 24,502. It's not. We know we paid a dividend of 6522. $17,980. That's our equity, okay? So basically what I did to prove that our equity is correct, I thought back to my accounting classes that I took, and I remember the statement of owner's equity. Beginning balance plus net income gives me the equity that's available for the period, minus out any dividends that I paid, which is right here. This is my ending equity balance. And they match, okay? So that's how we do number one, okay? Now, I'm going to go ahead and just delete these numbers just to make it easier for us. Well, for me, rather. So I'm going to delete all these. And I'm going to look at I'm going to look at number 2. So number 2 says the most recent financial statement for Courage Incorporated is shown here. So we have revenue of $6,700. We have $3,850 of costs. Our net income is $2,850. We have our original assets of $22,050. We have our equity of $8,050. And we have $14,000 in equity. Okay, I'm just setting up the problem. That's all I'm doing. Don't worry about any of these calculations down here. I just want to set it up so everything looks nice and neat. Okay, so I know what I'm working with here. So I'm going to make sure my balance sheet balances, which it better. Okay, we're good. So what do we need to do? They tell us that assets and cost are proportion to sales, debt and equity or not. So think back to problem 1, right? We can apply that percent of sales increase to the income statement. We can do it to the assets, but we can't do it to debt and equity, okay? They tell us no dividends are paid. Next year's sales are projected to be $79.06. So I'm just going to say right here, I'm going to put $79.06, and we're good, right? Well, sort of, right? This doesn't give me my percentage, okay? So I need to figure out what is my percentage, right? What is that increase of from 60, or what percentage increase is 6,700 to 79.06, okay? Very easy to do. What we do is we take, I'm going to kind of give you a saying here. We start off with the new number, we subtract the old, we divide by the old. That's actually pretty good. I'm going to say new minus old, divide by old, okay? That's how we calculate the percentage change. So I'm going to come right here, and in Excel, I'm going to calculate this percentage change. I'm going to say, okay, well, my new dollar amount of revenue is bear with me. Okay. My new dollar amount is $79.08. So I'm going to take that. Oh, usually helps if you hit an equal sign. Take 79.06, divide by, or I'm sorry, subtract my old, which is the 6,700. I'm going to divide by my old, and I get 18%. So this change from 6,700 to 79.06 is 18%. So I can now increase my cost by 18%. So to do that, I'm going to take my costs of $38.50, and I'm going to multiply that by 1.18, and I get 45.43. So my new net income is $33.63. Beautiful. Okay. Now, excuse me. I can go ahead and I can figure out what my assets are, because I know my assets have to increase by 18%. So I'm going to go ahead and take my original asset value of $22,050 and multiply it by 1.18. I get 26,019. Okay. So now I'm going to go right here and I'm going to plug in my debt 8050, or 8050, and I'm going to plug in my new equity, or my equity, 14,000. Okay. Assets and liabilities do not match, right? They don't match at all. But I can calculate my change in equity, right? How do I do that? Well, just like we did in the previous problem, we say, okay, I'm going to start with my beginning equity of 14,000. I'm going to add my net income. Then I'm going to subtract out any dividends. Well, the problem says you have no dividends. So I'm going to go ahead and hit enter. That means that my new equity is 17,363. Has to be, okay? So now what this problem is really asking us to do is to figure out what's the external financing needed, okay? Well, I already have it set up right here. Assets do not equal debt and equity, okay? There's a difference of 606. This right here is my EFN, or my external financing needed. Okay? So two takeaways from this problem really were, number one, I have an issue where not every single item is going to be, or is going to increase proportionate to sales, right? If they say revenue increases by a percentage, by default, okay, and we're using very simplistic assumptions here, costs have to be variable, meaning they have to also increase in proportion with sales, always. Okay, that's, if you guys had cost accounting, forget about that. We're just making the assumption here that all these costs are variable and they're going to increase in direct proportion to changes in sales. Okay, that's number one. Number two, luckily, assets did change in proportion with the net, with the sales. Okay, so we can calculate what our assets are. Okay, remember the way the logic works of a balance sheet, assets have to equal liabilities plus owner's equity. Okay, we have that here, right? It doesn't match. It's okay. We know how to calculate equity, right? We know the calculation. Beginning equity balance plus net income minus dividends gives us our new equity, or our equity balance, okay? We have that here, right? So what we're saying is, once we calculate that equity, we look at the assets and the liabilities and equity side, and we say, okay, these do not match. There's a difference of $606. We need external financing. How are we going to get that external financing? Doesn't matter. That wasn't our job. Our job was to figure out how much external financing we need, right? We could use debt. Maybe we could issue some more shares of stock, whatever we decide to do, okay? So that's problem number 2. I think I've been going now for about a half hour, so I'm going to stop this video. I'm going to come back and we're going to do number 3 and number 4 in our second video. So tune back in for that one.